Hey there, welcome to Maybe Invest. This video is inspired by the most recent Appendix 4C season we have had that finished in January, and also by the yearly and half-yearly reporting season in February. So this is 3 ASX stocks to watch. I was originally going to be calling this 3 ASX small caps to watch, but one of these companies I'll be focusing on today has a market cap of $1.4 billion, and in my opinion, that is not small cap. So this is part 10 of this video series. The three companies I'll be focusing on in this video are 8Common. Now, this company is right on being operational cash flow positive, and the big question I have is, can they continue that sort of operational cash flow positiveness moving forward, or even can they improve that? Because if they can improve that and show they are a legitimate business, no doubt the share price could re-rate over the next few years. The second company I'll be looking at is IOUPay. Now, I did a video on IOUPay about 4 months ago before they had changed their name to IOUPay. They were in the process of transitioning to their new business model, and that new business model is buy now, pay later, with a focus in Southeast Asia. This company has become quite popular among the ASX investing community because buy now, pay later, just for that simple fact, and the fact that the share price has risen from about 10-15 cents all the way up to 50 cents. And the final company I'll be looking at is Uniti, and this is the $1.4 billion company. Now, they are a very hungry acquisition type company, and my big question about those sort of companies is whether they can successfully integrate all the acquisitions into the business model. So I do have that question, but at the moment it does look like they are succeeding. They are operational cash flow positive to quite a high extent and are profitable, and that's the reason why ASX have told them they no longer have to issue any Appendix 4Cs from here on in. So their Appendix 4C they released in January of this year was their last one they might ever have to release. Now, for each of these companies, I'll be doing 4 slides. The first slide will be looking at the fact sheet and some of the financials, in particular the revenue, operational cash flow, looking at a yearly basis, so either the full financial year or the trailing 12 months. Second slide, I'll be looking at the operational cash flow at either the half year, full year, or the quarter. The third slide, I'll be looking at the history of the cash receipts. I think that's very important to see the sort of trend we are seeing in the receipts. And lastly, I'll be just be looking at the chart, the share price movements over the past 6, 9 months or year for each company. Now, the first company I'll look at is 8Common, ticker code is 8CO. This is a software solutions company with a market cap of about $34 million. When you look at their revenue and operating cash flow over the last 12 months, you can see revenue is at $3.8 million and the operational cash flow negative to the tune of only $100,000. So they're almost operational cash flow positive over the full financial year. If you want any further information on this company, I do highly recommend having a look at their Appendix 4C that they released on the 12th of January or their half-year report that they released on the 22nd of February. Now, when it comes to the cash flow, I did have a look at the half yearly that they released on the February 22nd. The first thing you'll notice here are they are now operational cash flow positive in only the half year, and it's only $78,000, so it's not that high. But they did do a capital raising during the half year, $2.25 million capital raising. So they've increased their cash on hand from $1.8 million to $4.1. So there's little doubt right now that they are able to maintain operations for the foreseeable future because they have enough cash on hand. And if they are able to become operational cash flow positive on a consistent basis, there's little chance they will do a capital raising because of operations. And the most likely reason they'll do a capital raising in this sort of scenario is if they do an acquisition. So the big cross against 8Common is when you look at their cash receipts history or the trend, and there really is no trend here when you go back to January 2018. It's really cash receipts is really going sideways. If you do a calculation of the compound quarterly growth rate, we're looking at a 1.4%. But if I take away the most previous quarter, in fact, you could argue that cash receipts have been going down. So at this point in time, the thing I really look for in this sort of company, which is growing cash receipts over time, isn't happening with this company just yet. Now, when you look at the 9-month daily chart for 8Common, it does seem like the market might not be agreeing with me in my assertion that this is not really an interesting company just because their cash receipts are virtually flat, or the growth in cash receipts is virtually flat. So we have seen a nice uptrend develop in the share price of 8Common since August of 2020. In fact, we did see a spike in volume at the back end of August, and that was really the impetus behind the increase in share price, or the beginning of a new uptrend. And I've just put in a brown line there signifying the uptrend. And at this point in time, if I was a shareholder, the only reason I would sell out right now of 8Common is if that uptrend was broken. And the second company I'll be looking at is IOUPay. Now, they do call themselves, well, they say their description of their business is to provide fintech and digital commerce software and services in Southeast Asia, but I would classify this company as buy now, pay later, servicing that area of the world, Southeast Asia. Market cap of 281, so you could say when you compare this company to other buy now, pay later businesses, there are good value at 281 million. Now, when I give you some of their financial details, like the revenue and operation cash flow for the most previous financial year, you have to take that with a bit of grain of salt, because a lot of these numbers are based off the old business model before they transitioned to this new business model of a buy now, pay later business. So if you do want further information on how this business is going right now, I do recommend having a look at the Appendix 4C that they released on January 29, or looking at their Appendix 4D and financial report. So this company financial year runs from 1st of January to the 31st of December, and they released their yearly financial report on March 1st, 2021. Now I'm going to show you the cash flow for the full financial year of 2020. Yeah, again, you can't take a lot out of this just simply because they have transitioned to a new model. But the one thing I can take away is they began the year with only $578,000 of cash and ended the year with $8.5 million. So how did they increase their cash? So more than likely they did a capital raising or borrowed some money, because they were operational cash flow negative by $1.7 million. So they did a capital raising, a $14.1 million capital raising, and that's the reason why they increased their cash from the beginning of the year to the end. And this is the cash receipts history for IOUPay. And again, this is based off their old business model, so we can't really see how the current business model is doing based off the history going back to October 2014. And unfortunately, we're going to have to wait maybe a year or so to see if there's any trend in how this business is performing, or the new business model is performing. So really, this slide is really not that useful at this current point in time. Now let's look at the 6-month daily chart for IOUPay. You can definitely see how the market has become excited with this company over the past 6 months or so. So 6 months ago, the share price was right on 5 cents or so, and in that meantime, the last 6 months, the share price has become a 10-bagger for any shareholder who's held through this time. When I first did a video on IOUPay, the share price was around 10 cents or so, and even since then, we've seen the share price increase by 5 times. Share price was hovering around 10 to 20 cents for a few months there between November and the start of February, and then there was some sort of catalyst the start of February which drove the share price from about 15 cents all the way up to 80 cents. Not sure what the catalyst was, but it was mostly over 3 trading days. And then since that high of about 80 cents, the share price has been drifting down towards 50 cents, which it is right now. And one of the reasons why we have seen the share price coming back is because a lot of the buy now, pay later companies have been affected by the rising bond yields, which is affecting the tech sector, and any non-profitable tech companies will be affected by any further increases in bond yields moving forward. And the final company I'll be looking at is Uniti. This company is a diversified provider of telecommunication services. They are very acquisition hungry sort of company, so they're continually doing acquisitions. And I am wary of those sort of companies because it can be successful in the short term, but you can't keep doing that because over time it becomes harder and harder to successfully integrate acquisitions into the business. So it's been successful for Uniti thus far, but just how long they continue having that sort of business model moving forward. They do have a market cap of 1.4 billion, so this is not really a small cap at the moment. But when you look at the revenue and operational cash flow, you can see the revenue is growing quite strongly and the operational cash flow positive for the trailing 12 months, $44.6 million. If you do want further information on this company, you can have a look at the half-year report, which they released on the 23rd of February, or their final Appendix 4C, which they released on the 27th of January. So with their cash flows, I'm just going to focus on the half-yearly cash flow statement because when I looked at this, it was a very busy cash flow statement. A lot is happening with this business over the previous half year or 6 months. You can see they were operational cash flow positive by $26.6 million, but they did lose $144 million of cash. So they began the half with $189 million and finished the half with $45 million. And the main reason behind that was that they did a really big acquisition. In fact, the first line in the investing activities section, you can see they paid $619.8 million for a purchase of a business. So the question is, how did they fund that acquisition? And the two main reasons you can fund an acquisition is, well, three main reasons, is any cash on hand you have, borrowings, or capital raising. So how do they do it? Well, they use a combination of the three. They did use some cash. They also borrowed $305.6 million, and they did a capital raising to the tune of $168.3 million. So a very busy looking cash flow for a company, but a lot is happening with Uniti at the moment. And this is the cash receipts history for Uniti. This is exactly the sort of thing you want to see for a company you might want to invest in, an increasing trend in the cash receipts, and it's actually been accelerating over the last quarter or so. But the big question I have when I look at the cash receipts is, what percentage of the growth is due to acquisitions and what percentage is due to organic growth? I think it's very important to know the difference between the two, because are they growing through acquisitions mostly, or are they growing through organic growth? Compound quarterly growth rates since April 2019, 34% per quarter. So that's really good growth. But again, how much of that is attributable to organic growth? And here is the 6-month daily chart for Uniti. Not much was happening up until the end of November, start of December, when we saw the share price start to increase and we started to see the moving averages turn around. So this was a potential start of a new uptrend around the $1.50 mark, and we've seen the share price continue into a nice forming uptrend from then on. So the share price right now is at $2.11. I'd like to see the share price fall towards $1.90 to $2. I think that there's a really good support level right on $2, and if it maintained above $2, that would be quite bullish moving forward. So this is a very interesting chart when I look at it right now. Now that's all I've got for this video. The main reason I do these videos is to share ideas, and hopefully I get to inspire someone to follow up or do more research on one of these companies and potentially make an acquisition. So hopefully I've inspired at least one person out there. If not, that's okay as well. Now, I'm not a financial advisor, so if you do need financial advice about your financial circumstances, make sure you seek out someone who is qualified and can speak to your own financial needs. That's all for this video. Have a good day. Bye.